Kevin Green is with me. We're going to talk some macro before we get into a few of those specific company stories. Looking at this morning, KG, thinking about trading opportunities, and the thing that stands out to me is bonds. Almost a 50 basis point rally in the 10-year futures right now, despite pretty warm PPI numbers that seem to fit yesterday's CPI narrative, the way Rebecca put it. I kind of agree with her. So should I be shorting bonds here?
Look, the reaction for bonds, I think, is really the fact that they're discounting the energy impacts that we are seeing when it comes to PPI and CPI. And if that's going to be the case, and they do believe that it's going to be a short blip there, and we have a revision back to the downside, maybe we can bring in and pull forward rate cut expectations. We had that bump to the upside yesterday. If you kind of look at the high to low on the yield chart for today, if you look at that high to low, I don't have it listed here, but basically, that tip of the around 4.66 was actually around a 61.8% retracement from high to low, from 4.8% down to around 4.4%. So there's a technical reversal that is taking place. If you do believe yields are going to continue to go up, you come back, retest around 4.5%, and then that's where you would see kind of yields maybe bouncing back to the upside. I still think the technicals kind of say that yields still want to either remain at these levels and or go higher here, Oliver. And we still have a lot to go for today. We have a 30-year bond auction. We will have an announcement when it comes to tariff policy. This is supposed to be the big one, according to Donald Trump. And if it's a little bit more aggressive than what the street's really pricing in, that's where you can probably see yields kind of inching higher here. But it is an interesting reaction that we had post PPI. But once again, I think it's more of the fact that they're discounting energy.
Okay. And when you say discounting energy, you're thinking that people are just kind of assume that the energy pressure is going to be solved here because we're going to pump a bunch more oil?
No, look, that has nothing about policy right now is being factored.
Because I'm a doubter of that too. It's like these companies have already been pumping a ton. So
a couple of things there. So one, no, the market's not really pricing that in. So we already have seen a retracement to the downside for crude oil, right? We had $80 in January because of the Arctic blast and logistic issues, increased sanctions, and then we had a quick reversal to the downside. I believe we're trading at around $70.50 or so, and we could have more room to go to the downside. And in fact, if we have some geopolitical risk items that are going to be on the calendar for this weekend actually play out in favor of the ceasefire deal actually holding, you'll probably see crude oil move to the downside even more. So I think it's more weather effects that we saw an increase when it comes to energy prices. And once again, that was a huge factor, a big factor that we had. And then the food side of the equation is just something that is just inherent in nature when it comes to food. I mean, unfortunately, it is what it is. So I think that's really what a lot of energy traders are really focusing on here. What's the demand side factors? And right now, everything as far as price advances have been supply side driven, which is why you can discount maybe by March or even by April that report that CPI and inflation metrics just as a whole will subside here. I think that's really the case that the market's really pricing in right now.
All right. Well, the temptation to stab short bonds is definitely itching this morning after the rally. Dollar off a little bit, 9 bips, and nothing too much there. Yesterday, you were talking to me about how the dollar kind of looked heavy, and I'm starting to see that as well. I dropped the green light on my risk radar for the dollar. What do you think about that? Does it look heavy to you? Because, I mean, you were talking about that yesterday. I'm kind of starting to see that a bit here.
Yeah, so the dollar does look a little bit heavy. If you kind of look at the technical setup right now, we are in this consolidation pattern. And actually, you could say, if you're looking at a candle chart, that we are seeing potentially a very small, but head and shoulders pattern that looks like we're about to test the neckline, which would be around 107.5 if you're looking at dollar sign DXY. And then also, once again, the favorable factors when it comes to some of these other currencies. So the euro US dollar pair, we do get some form of a agreement or a resolution for the Ukraine-Russia conflict that actually should push the euro up a little bit. That should also push prices for natural gas in the European markets down. So that actually will be favorable for them. And then once again, I mean, if we have, this is the big one when it comes to tariff policy, the market might be looking forward and say, okay, we might not see any more, tariffs being added on here. You probably could also see a reversal in the US dollar, Canadian dollar pair, which is at historic levels or was close to historic levels. So there's a lot on the fundamental side that makes the case that dollar should go down And I think the technical side is kind of saying the same thing.
And you're kind of arguing that the dollar's caught a bid from tariff stuff, so as they come to fruition, the market might kind of sell that news for the dollar, which I'm sympathizing with, because yesterday the dollar really looked like it should have been bid, and it was early, but then it lost it. So heavy indeed. All right, hey, give me real quick the S&P look on open interest in the levels, just real fast, because we do want to talk some stocks here, KG. But I mean, S&P's 15 bips, so nothing's changed too much, right?
Yeah, so we're testing the upper end of this channel line that we've been following here. We kind of broke through it early on in the session, and now we're kind of failing below it. The day is going to be all about market participation. So what am I looking for here? 60-90 to the upside is going to be your key area that you want to really focus on. Obviously, that's really close to 60-100. And if we do see any type of failure today, 60-50, hopefully we get a bounce there, some buyers step in, and we continue to move higher. Any failure, you're actually looking at around 6,000. And we actually seen some early, interest when it comes to the 59.79 put flows. So be mindful of that too. The tariff policy announcement should theoretically be bearish on the market. And then I will also highlight too, you want to look at the equal weight S&P 500. That's going to give you that telltale sign. If you look at the last 6 months, we don't really see sustained rallies to the upside unless we see market breadth. And this morning we saw some pretty decent market breadth. But once again, that fades a little bit. It makes it a little bit harder for us to try to advance in this type of environment.
All right. Okay, so we have found rejection at similar levels on repeat, and we hope that maybe today we have some more gumption to try it, but I don't know, it doesn't look like we're kind of fading as we speak. So.
Yeah, I'm sorry, Oliver. Can we just show just one chart? It'll be really, really quick.
Sure.
The E-mini S&P 5-day, 15-minute chart. So if you're an intraday trader, this is actually very key. The reason why we are rejecting here, this is actually a resistance area that we've seen from pretty much Tuesday to right now. Yep. Okay. And then you see that upper channel line on those lows there. So you're looking at 60-30. Any type of meaningful failure, 60-30 on the E-mini S&P futures would be your area to hold. Anything that breaks below that, you break this whole, setup, if you will. And that's where you kind of look at the flush to the downside, or even more of an aggressive flush. So that's an intraday E-mini S&P chart that kind of signifies and justifies the reason for that pullback.
Perfect. No, perfect. Exactly. Love to see in the chart form exactly what we're talking about, the multiple rejections. Bitcoin also just slipped below 96, so a little bit of a breakdown there. Kind of argues more for maybe risk-off shift this morning. The bond thing I was mentioning too, I guess the risk if you do try and short bonds here is that bonds catch a bid if stocks sell off. So that's kind of one thing to be wary of. So I am watching treasuries to see if maybe the bid in treasuries is saying we could go risk off today. All right, let's talk stocks. Cisco first. It looked like a fantastic number yesterday, 6%, but I don't know, not enough to carry the market on its back right now. We're not doing much despite this.
Yeah, Cisco is not really a name that really does kind of influence the broader technology, sector as a whole, right? There's some pockets of strength and weakness within this report, but I think they actually had some pretty decent numbers. Adjusted earnings per share came in at 94 cents. Street was looking for around 91 cents. Revenue came in at 13.99 billion. Street was looking for around 13.87 billion. And then they also revised their guidance for revenue as well as EPS guidance for the next quarter up. And so they are seeing some demand when it comes to AI infrastructure. They did see around $350 million worth of orders for the quarter. That makes the year-to-date total right now for AI infrastructure orders up to 700 million. They do believe that they're going to hit $1 billion by the end of this year here. Networking division did see actually a decline on a year-over-year basis by 3%, but that was actually offset by the security unit as well as the Splunk acquisition. Splunk is really helping them out on top line when it comes to growth here. So it was a good report, maybe a little bit of the sell of the news type of an event. It's not a stock that really does see, 15, 20% moves to the upside or downside on earnings. I think it was only being priced in for about 3.5% implied move. And that's pretty much kind of where we're trading at right now.
Okay.
Yeah, about 4%.
So it's kind of, it's within the realm of expectations, operating within those kind of options driven expectations. Great chart still, maybe it doesn't move the market. Maybe it's not the hero like in NVIDIA, or an Apple, but boy, is it a beauty of a chart. And it does correlate very well with cloud companies. So with that sector down this morning, maybe something to think about, because Cisco is benefiting from all this, then you would think it's a pretty good message for anything connected to data centers, demand, networking, all the different infrastructure that's going into it, but not a lot of love for the broader groups this morning. With cloud lower, Semiconductors unchanged. Really the only thing in the tech space outside of this that catches my eye is Tesla getting another bounce, but that was kind of a rocky one yesterday into the close. How about Reddit, KG, down 8%? A beauty of a chart, a wild one, from 37 bucks to 240 in the last year. As I understand it, a lot of people have embraced this as their social media kind of landing page, their home page. So Reddit now is a pretty big beast, I think, when it comes to our conversation about social media.
It has been, and I think obviously there's an AI angle that's here as well. They continue to ink deals with a lot of financial firms, and even exchanges, for that matter, in order to try to utilize the data that they have on their platform to train AI models. So that's really the edge that they actually have for the market here. Now, when you're looking at the earnings for the quarter, they actually beat both on the top and bottom line. Revenue came in at $427.7 million. Street was looking for around $405 million. Ad revenue, once again, beat the Street's expectations, up over 60% on a year-over-year basis, and adjusted earnings per share once again exceeded the Street's expectations. That came in at 36 cents. But the reason why you're seeing a little bit of the sell-off here, daily active users actually came in short of expectations. For daily active users, that came in at 101.7 million for the quarter, up 39% year over year, but the Street was looking for 103.1 million. And so that's where you're seeing maybe a little bit of that weakness. Now, they did acknowledge that they are seeing maybe some weaker traffic to the site because of the Google search algorithm update that we've seen. That's been happening for the last couple of quarters here, but now they're starting to see a little bit of a meaningful impact here. But overall, it's been a really decent start. You're seeing a sell off right now, but when you're looking at the trajectory of this chart, I mean, a pullback is kind of warranted at this point.
All right. Yeah, I get that. I sympathize. But I don't know. The more, I guess, look, for some people, they've been Redditors their whole lives. For me, it's kind of been like a new thing that's kind of like entered my life for whatever reason. Part of it, I think, because like the For You stuff on X is just terrible. And like generally I'm an X defender. You know, I like Twitter, I like X. You know, I'm not an Elon hater by any means, but like the For You stuff is just, it's just still not working for me, you know? It's putting stuff in there I don't need. Whereas I know that Reddit can be very specific, very tailored, very useful. So and the other thing too is from, like you said, from the trader standpoint, a lot of people, there's a lot that goes on in terms of commentary and figuring out, you know, trading strategies in the community there. So there's a whole community element to it as well that it sounds like it's spinning off some useful data for them to profit on.
Yeah, actually, they have a deal with the international, with ICE.
With ICE, yeah.
Basically, the ICE exchange. So that, once again, it's very informative. I think when you're kind of looking at their platform and the use cases, I believe it's going to be more sentiment driven data that a lot of these financial firms or just ad companies and things of that nature really want to see, rather than actually utilizing Reddit's information that's on their platform as fact. And I think that's really the key that you're getting when it comes to these deals, and that's why it's seeing a little bit of a premium. And the hope is that they're going to continue to see that traffic move up to the upside, more traffic, more data that you can sell, obviously more profitability. And so that's the business model for them right now. Yeah, I haven't used Reddit in years. So I don't know. It's and X is all right, but For You can tell that there's a skew.
Maybe you're a Reddit guy. I was thinking maybe.
No, man, it's like a hellscape on that thing, man. You know, that's just my 2 cents on it.
Hellscape everywhere. It may be
pretty much.
It may not be platform specific. Hey, last one real quick. Deere hit early, but trying to find some buyers here. I can say I didn't realize. I know we talked about it last earnings because Deere had a big pop, and then I kind of forgot about it. I hadn't realized that it had kept climbing. What's this about? Is this any message about commodities or anything, or what?
Oh, yeah, definitely. So what is happening to Deere right now, they actually did miss the top line net sales aspect of their quarter, right? So that came in at $6.81 billion. She was looking for $7.7 billion. Adjusted earnings per share actually did beat, but revenue did fall around 30% on a year-over-year basis. North American sales dropped 30%, and that is actually a very big problem here. What they are seeing is that higher interest rates is actually discouraging a lot of these farmers from actually purchasing their equipment, and they're going more towards the leasing route or the rental type of route here, which is obviously a little bit less profitable, even though on the other hand, other side of that, volumes actually do increase with that particular model here. But the fact that we are seeing depressed prices when you're looking at corn, soybeans, wheat, that actually does have a direct correlation to the performance of Deere Company, and they will also have some dollar risk as well, or some foreign exchange risk for their business. This one is the one to keep your eye out on for today. With the tariff talks and the commentary that comes out of the White House here, this could be a big target on the back of some of these countries that may want to retaliate. And that's an unfortunate situation, but that has happened in the past, especially when you're looking at the first trade war that we saw in the first administration.
True. Okay. So there might still be some cross currents that we got to process for a company like Deere. So I kind of get why maybe there's a bit of a bias to retreat after anything that's disappointing in these numbers, especially considering how much it rallied last earnings. Thanks, KG. Great analysis. Great work there. Nice job. Heavy lifting from the macro and the technicals into the stock specific. Really nice work, Kevin.